Welcome back to Synaptic Dividends. Today, we're going to dig into a true industrial giant, a name you see on construction sites literally all over the world, Caterpillar. I mean, their big yellow machines are absolutely iconic, but for us income investors, the real question is all about their dividend. So that brings us to a really simple question. Is Caterpillar's famous dividend a rock-solid source of passive income, or is it, maybe running on fumes? To figure this out, we don't need some complicated financial theory. Nope. We just need to look at a few key numbers. All right, let's get into it. Okay, first up is my absolute favorite metric for dividend safety, the free cash flow payout ratio. To me, this is the most honest number you can find. It tells us what percentage of a company's actual, real, hard cash profit is used to pay out the dividend. Think of it like your own budget. If you get $100 in your pocket, how much of it are you spending? For a dividend, a lower percentage is always safer. Now, what's really interesting here is the resilience this chart shows. Look at this. Back in 2020, during all that global uncertainty, the payout ratio was a very safe 41.1%. Then you fast forward to the boom year of 2023, and it dropped to an even more impressive 26.2%. And you can see the most recent number, which covers the last 12 months, is also incredibly strong. Let's actually isolate that number so we can really see what it means for the dividend today. Right, so over the last 12 months, that number is sitting at a very comfortable 36.6%. The key takeaway here is this. Caterpillar is only using about 37 cents out of every single dollar in cash it generates to pay shareholders. That leaves a massive 63 cents on the dollar for everything else, reinvesting in the business, paying down debt, or just building up a bigger cash cushion. This just screams margin of safety. But look, safety is only half the story, right? We also want reliability. And this slide, wow, it shows it in one powerful number. Caterpillar has increased its dividend for 32 consecutive years. Just think about that. That means through the dot-com bust, the 2008 financial crisis, and the 2020 pandemic. Through all of that, management found a way to not just pay the dividend, but to give shareholders a raise every single year. That is the kind of track record we absolutely love to see. And get this, that growth isn't just sputtering along, it's actually speeding up. Over the last 3 years, the dividend has grown at an average annual rate of over 8%. Now, this is not just some tiny token increase to keep the streak alive. No way. An 8% growth rate is a powerful signal from management that they are extremely confident in the future cash-generating power of the business. They're not just maintaining the dividend, they are aggressively growing it. So, let's put all the pieces together and answer our original question. Is Caterpillar's dividend running on fumes? Well, the numbers tell a pretty clear story, don't they? It's being paid from just a fraction of the company's cash flow, which gives it this huge safety buffer. It's backed by over 3 decades of uninterrupted growth right through multiple crises, and that growth is actually accelerating. So, based on the numbers, this isn't a machine running on fumes, it's a well-oiled, rock-solid income machine. So the numbers paint a really strong picture of the dividend today, but the big question for any investor is always, what will these numbers look like tomorrow? To understand the business strategy, the competitive advantages, and the management decisions that are going to drive Caterpillar's future, well, for that, you have to check out our deep dive analysis on our main channel, Synaptic